in any given investment, we are looking for like 5 to 7 discrete ways to win, right? And so because I know like life always gets in the way, there's no straight road to Rome. And so the idea is to have clear, clearly identified initiatives and projects, right, that are kind of in the 7 to 10 range, knowing that, hey, a decent one of the, a decent set are going to flop. But even if you hit 3 or 4, like the business is going to do really well. And the market is going to tell you. Your customers are going to tell you, your adoption rates are going to tell you, your activation rates are going to tell you which one of those kind of exist.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Omair Sarwar, and he is the founder and CEO of Gearbox Capital. And Omair and I met back when he was at SFW as an investor, and we worked on a couple of engagements together, and we've known each other since then. And he's left SFW to found Gearbox. And what's really interesting about Gearbox is they work closely with founders and invest in software companies and B2B companies. And Omair's approach is very meticulous in building relationships with the founders to understand them at a deep level, and then figure out what's the best way to handle their companies as almost like an outside partner for the entrepreneur and the founder. So Omair and I get into deep conversation about why this approach has proven successful for Omair, what unique perspectives and advantages Omair and Gearbox are able to bring to their companies, and especially just managing the founder relationship, given how different entrepreneurs are and what really motivates them in order to create value in the marketplace. So I thought it was a really insightful conversation, and I hope you take a lot away from it as well. Enjoy the episode. All right, Omair, welcome to the show. How's it going?
Hey, I'm doing really well, Shiv. Thank you for having me.
Yeah, excited to have you on. Obviously, we've known each other for quite some time, but for the audience's sake, why don't you introduce yourself, your background, and what you're up to now?
Sure, for sure. Omair Sarwar, I've been fortunate to have been investing in founder-led bootstrap technology companies for over 15 years. Prior to launching my own entrepreneurial journey and kicking off Gearbox, I was the co-head of the software and information practice at SFW Capital, which was a pretty specialized technology firm, and had a variety of private equity roles prior to that. But really the common thread through all of those was this passion for and developing partnerships with founders and bootstrap companies.
And what led you to start your own thing? Because obviously SFW is a reputed PE firm and things were going well there. So what led to the change on your side?
Yeah, great question. I'll tongue in cheek, I'll put it like, some part midlife crisis and some part, entrepreneurial itch. But essentially, I've been at that firm for 10 plus years, and helped to build and develop their software practice. And um, there's an element of private equity where, kind of success begets success, of course, but you end up, a certain type of private equity firm ends up doing larger and larger deals, right? And you start to kind of gravitate, and that's, classic to the industry, where that's how you collect larger assets under management. And what I found was that I was, forced is maybe the wrong word, but kind of oriented. I was being nudged towards doing larger and larger transactions. And what ends up happening, or I found, was you end up dealing with a lot more. It becomes a lot more transactional, right? The management teams are professional. In some ways, they're almost mercenary, right? Not that there's anything wrong with that. And the sellers become other private equity firms, and so there's it's just a very different dynamic. And as I reflected, I was turning 40, and as I reflected where I want to spend the next decade of my life, I realized that some of the most fulfilling aspects of private equity and investing for me was actually working with founders, people that are just deeply passionate about their products and customers and their culture even, right? And that's been a much more fulfilling experience for me. And so as I realized that's what I want to do, and by nature, you kind of, that requires working with and partnering with smaller companies. It just became less of a fit relative to the strategy that SFW was trying to pursue. In between that and kind of some other strategic things that I wanted to focus on at Gearbox, similar to kind of building our great, offshore arm back in Pakistan. I mean, there was just a lot of nuances to it, but I would say that was the fundamental thread that said, "Hey, let's try and start something that kind of feels connected to my values."
Yeah, and I want to jump into Gearbox as well and hear more about that. But just before we do, just to round out what you brought up here in that answer is you mentioned this need to invest in larger companies or deal sizes. Is that just a function of PE funds growing, raising more capital, needing to return the fund? Like, just help us understand those dynamics and what goes into that reality.
Yeah, and I think it's somewhat connected to the kind of strategy or philosophy a private equity firm may have, right? There are obviously some great firms that are very comfortable in having, larger and larger portfolios, right? Now that requires more and more partners, and kind of you're starting to, build a pretty large scale team. The other model for growth is kind of what SFW was following, which is, continue to have a very concentrated portfolio, right? Small group of partners, but the only way to scale that model, right, is to do larger and larger deals if you want to continue to kind of grow assets under management, grow fund size, et cetera. Look, I mean, personal capacity of a private equity partner starts to tap out at like 4 to 6 investments, right? And so the only way to grow is to do, instead of, where we started, we were writing $25 million equity checks. And by the end, when I left, we were writing $60 million equity checks, right? And so it's just there's nothing that, you can be successful doing either strategy. I think it's just kind of the path that you want to go down. And again, it's kind of connected to personal interests and kind of what kind of philosophy and strategy you want to pursue.
And so, switching over to what you're doing now at Gearbox, how is that different, or how are you approaching this venture and opportunity differently?
Yeah, for sure. I mean, I think there are a couple of different elements. I mean, I can walk through our core philosophy, but let me maybe first talk about the differences, right? The differences, one was I wanted to refocus on what other people may think of as the lower end of the market. I think of it as these are founder-led, bootstrap companies that have some very interesting elements. They're very product forward, and they're genuinely looking for partners, right? And I'll get into some of those aspects. So that's a slight difference from, being in a lot of investment banker-led auction processes where you're under the gun and like, everyone's kind of, it's like speed dating, right? So I think that was one difference that was fundamental. And then the other thing, element that I wanted to do was, look, I'm an immigrant. I was born and raised in Pakistan. And, again, it's interesting, you start to hit middle age and you want to start building some connectivity back to your country of origin and your birth. And I thought there was this great opportunity to um, both allow me to contribute back to my country of birth, but also act as a really interesting value creation driver for these companies, which is to build a back office arm, operations arm in Pakistan, to support these portfolio companies around, finance, R&D, marketing, et cetera. Because oftentimes what I found with these founder-led companies is they either don't have the scale or they don't have the skill set to really take advantage of offshoring effectively. And offshoring gets a bad name because of that. But Gearbox acting as an aggregator and a center of excellence has been really powerful, actually. So those are kind of, I would say, the two core strategic differences that I wanted to apply in terms of setting up.
Talk about that second one a little bit more, just
Yeah.
operationally. How are you bringing offshoring to these companies?
Yeah, for sure. I mean, so um, let's say you're a small, founder-led company. I'll give you to make it real, Office Timeline, for example, which is a wonderful business that we have the fortune of partnering with in Feb of 23. Cash basis accounting, right? Super technical. Not that there's anything wrong with that, but a typical CFO search takes anywhere from 3 to 6 months, right? And they're incredibly expensive. But we have as part of our team, a former Ernst and Young audit partner, right, who is able to come in day one at a fraction of the cost, that understands like the Gearbox operating model from a finance perspective, and we're off and running, right? And that's one example. Another example is building dedicated R&D teams, right? Look, you're also an immigrant. I don't have to kind of communicate some of the economic advantages to it, but even in addition to economic advantages, right? And Office Timeline has now a big team in Pakistan. It's you can access in our country the top 1% of talent, right? And they will be grateful for this job, and their retention is incredibly higher, and and they're incredibly capable, and at a fraction of the cost, for example. But it's not even cost. I mean, it's just velocity and scale. You can just scale so much faster if you have a trusted partner with
Hmm.
dedicated feet on the ground to be able to commit to that.
Right. And I guess the difference is that most companies don't have access to like a local counterpart that can help them build that. As an example, our last business, Wild Apricot, we had an entire developer team in Zelenograd, which is a suburb or in the outskirts of Moscow,
Yeah.
and that it was a huge advantage because we were able to get premier developer talent and technical talent, which here would have been multi six figures, but there was a fraction of the cost. But we were able to have a much larger engineering organization as a result of that. But in order to do that, we actually had boots on the ground and folks that knew the Russian market very well. And I guess most companies don't have that.
That's exactly right, and you'll see this thread I think throughout our conversation. But like it's so much of it is about trust, right? And it can be hit or miss for a lot of companies, right, that are trying offshoring for the first time. It could be you may get lucky and you may get a truly trusted individual, or you may be unlucky and you get somebody who's double billing you without telling you in the back, right? And so and that's just the economic element to it, but then there's a quality element to it, right? Whereas I think in our example, similar to what you're saying, I mean, we can maintain quality of talent and retain them because as Gearbox, we're not interested in necessarily generating a profit on those resources, right? I mean, we're trying to make sure that our portfolio companies are successful. So there's also that dynamic of a vendor, an independent company that's like its own profit generating entity versus just somebody truly that is in service to, greater vision and objective.
Let's talk about the founder element of it, because you also mentioned that you were passionate about working with these smaller businesses that are founder led. So is that where you're spending most of your time, which is vetting founders and meeting with them?
Yeah, 100%. It's a personal passion project as well as I generally think it makes a lot of commercial sense, right? And typically, what you would see any Gearbox investment translate into is these are relationships that we're trying to cultivate over a 12 to 24-month period, right? Um, and part of it was look, it's um, to be able to accomplish these partnerships and these investments outside of you know uh, being under the gun, driven by an investment banker, et cetera. I mean, I find it fascinating that the real life equivalent to an intermediary driven auction process is like speed dating, right? And did you? I don't know the math on this. I don't know the statistics, but would you feel comfortable finding your life partner through a speed dating process? And so, I've always found it fascinating that for founders, typically this is one of the most important milestone of their life's work. And so, would you rather get to know people over time, not only just when the suitors are on their best behavior, right? Um, and is that in your interest? And so that I think just makes so much sense, particularly as the world just gets faster, more transactional. To me, I've just always gravitated to this philosophical element, and that's from the founder perspective, and then from our perspective, how a founder approaches kind of this milestone of their career, of their life's work, it tells you a lot about their values, right? And their incentives, and do they care about their product and their customers and their culture? Because they should be bringing the same level of thoughtfulness to a transaction like this as they would to products and customers and their culture and their employees. And so I think of it as a win-win, right? I mean, because it allows us to test for values, right? And I'm fortunate, kind of like you, Shiv, I'm fortunate that I'm in a point in my career where I get to choose the people I work with. And these are lessons that have been learned over time with, battle scars to show for it. But, I'd like to think that I've done something entrepreneurial to support that, finding people that kind of share common values.
What are some values that are important to you or that you're looking to partner with?
Yeah, for sure. I mean, we're pretty transparent about those. They're, a lot of people throw these values out, but if you go to our website, right, and what you see there, actually, I put a lot of thought into those, and so it's everything from having, strong product focus, right, and having a mindset that's oriented around responsible growth, as we call it, right? There's an element that we call folks that have an action bias, right? I mean, I kind of love this phrase of like cowboys are better than professors, right? And that's just kind of a value that we have. And then finally, like culture, right? There's that great saying that culture eats strategy for breakfast, right? I mean, you have I feel a lot of private equity. Most of the folks that end up entering this industry, they tend to be very analytical. They tend to be very strategic, but it's like culture eats strategy for breakfast, right? And so, or for lunch, or whatever analogy you want. And so, those are some of the values that kind of are important to us. Those are what we live by. And so, and the beauty of it is, it takes time to figure out if somebody exhibits those values, right? It's kind of, again, it's like an analog to a marriage or a life partnership. You always hear from everyone saying, hey, values are really important. It's important to have consistent values with your life partner. Well, this is a partnership that's like, it's maybe not to the same extent, but it's very similar because these are 10 plus year relationships. And so wouldn't you want people that share your values? And how do you get to that point? It takes time, it takes effort, and it takes collaboration, usually.
Yeah, I really like a lot of what you said there, especially the cowboy comment. For me, I love working with founders, and actually, I use cowboys a lot as an analogy. Is
Yeah,
one of the reasons why I like being a founder, and
yeah.
I love talking with entrepreneurs and founders. Is that I find that they are incredibly good at building their own ecosystem and their own thing that is not reliant on others to generate value for themselves and their communities or families or people who work for them. And I think you kind of have to have like a cowboy mindset in order to do that, and that involves like taking on a ton of risk and being
Hmm.
comfortable with that, and being comfortable with uncertainty
Yeah.
and being able to operate with a ton of uncertainty.
And be decisive and make decisions. I mean, I again, I have so much respect for Tim Stumbles, who's the founder and CEO of Office Timeline. That dude is a cowboy, but in a thoughtful, mature way. I don't want to make this sound like cowboys just, you're kind of firing blindly. That's not the intent, but it is that's why I always use like cowboys greater than professors, right? It's not kind of go around willy-nilly shooting stuff. It's that don't overanalyze, try to avoid analysis paralysis, and just have an action bias. Because I think particularly for a lot of our product-led growth companies, and you know this, right? Experimentation is such a core part of these kind of companies. And so you almost have to have that cowboy mentality to be able to iterate
Yeah,
really
and
fast.
while maybe things are not working or
Yeah.
you're risking your capital, like a lot of founders also like delay taking out dividends, they reinvest into their companies when it would be much easier just to take the money out and buy, five sports
Yeah.
cars. But like you're but they kind of reinvest because they believe in something and they kind of
Yeah.
grow the business and it impacts all the people around them. So I totally
Yeah.
identify with that.
Yeah.
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 So talk a little bit more about because as you meet these founders, like how are you trying to separate out the winners or the real entrepreneurs from folks that maybe are still finding their way or figuring it out and not yet ready for an investment.
Yeah. I would say I want to be careful not to say that somebody is a real entrepreneur or not, right? I mean, there's like everything else in life, there's just a flavor of,
Right.
and there's nothing wrong with any brand of entrepreneurship,
Yeah.
right? I mean,
Sorry.
yeah,
Just to fix that, I would say more like someone that you as Gearbox are
yeah,
in a good place to back as an
yeah,
investor.
yeah. And for us, again, it starts with those values, right? It starts with those values. And the way we kind of align around those is typically through a very collaborative process. It's kind of the way I communicate this to founders is like, look, when you hire somebody, right? Guys, when you're hiring an executive, you typically put them through a case study. You put them through working sessions, right? Why do you not do the same thing with investors? Because I love doing that with founders, and so what we will do typically is engage with people, and we're happy to make that investment around like a lot of working sessions, collaborate, a lot of collaboration around um, eh, building a growth strategy for the business, applying some of the tactics and playbooks that we have built over the years. And again, it's a win-win because we get to observe the execution of those initiatives and how founders are, taking some of our advice and manifesting that in the business. And at the same time, they get to see if we're blowing smoke up their ass or actually we know what we're talking about, right? And so typically the way it manifests is through what I call our pulleys and gears framework, which is kind of our value creation strategy, which we work, most of these companies through. And to put that into perspective with an example, so an office timeline, for example, right? We met Tim and Eddie. It's just wonderful people and such a passion for their product. Um, and we met them, 18 or so months before we actually decided to partner up. And over that time, for example, we worked with Tim and Eddie to essentially define the pulleys and then the gears, right? And so an example of a pulley would be, the 3 to 4 core vectors that are going to drive long-term growth. And so in Office Timeline's case, a big pillar for us or a pulley was product expansion, really more enterprise centric. Product expansion was very PLG business, very kind of organic viral growth, but there was such an opportunity to deepen their capability into the enterprise.
Hmm.
That's a pulley, right? A gear would be like the tactics and the playbooks that we can kind of execute in the near to medium term. And so the gear would be, hey, if the pulley is product expansion, the gear is let's develop functionality for the enterprise, or let's eliminate friction from the onboarding process, or let's expand ecosystems and integrations, right? Those to me are gears, but it's kind of developing that capability, um, planning that strategy with them. And then what we observe, to Tim and Eddie's credit, they executed on some of those things. And the ecosystem strategy was incredibly successful. We just launched our enterprise SKU, right? A few months back that is seeing great adoption. we engaged with them on some pricing and packaging opportunities. And so it was, it works both ways. And so we saw their willingness to take some of our suggestions and implement really fast and really well. And they kind of saw our capabilities in action. So I think that's kind of the thesis and the approach.
Using that example and this framework, how do you vet ideas? And I'm getting more into just the tactics here, but
Yeah.
how do you qualify ideas that might be too far removed from a company's core market or area of expertise or where they actually win deals, versus like things that are maybe more of an adjacency where there is actually opportunity, right? Like a lot of companies, for example, want to go up market or down market, but usually it's much harder than they initially think, and it requires a much bigger investment in product and sales processes and service capacity and everything else that goes along with that. So just
Yeah.
talk a little bit about how do you vet that through the framework?
100%. That's a fascinating question. And prioritization is one of the most important and one of the most challenging things to do, right, for any business, particularly the kind of businesses that we work with. They have, it's almost like they have too many opportunities, right? They could go in like too many different ways. And so it's a fascinating exercise. I would say philosophically, right? And this is where the pulleys and gears kind of come into play. Whereas I'm a strong believer in kind of the experimentation mindset. And so in any given investment, we are looking for like 5 to 7 discrete ways to win, right? And so because I know like life always gets in the way, there's no straight road to Rome. And so the idea is to have clear clearly identified initiatives and projects, right, that are kind of in the 7 to 10 range, knowing that, hey, a decent one of the, a decent set are going to flop. But even if you hit 3 or 4, like the business is going to do really well. And the market is going to tell you. Your customers are going to tell you. Your adoption rates are going to tell you. Your activation rates are going to tell you which one of those kind of exist. Now, that's kind of the philosophical approach, right? Then, in terms of actual prioritization, um, again, we are kind of very product first folks. What does that mean? Essentially, what's one step after or before, depending on how you're looking at it, is customers, right? So, oftentimes, um, your customers will be telling you kind of what they want in the near term, right? And we have a lot of frameworks and playbooks around kind of figuring that out. In Office Timeline's case, this is a product-led growth business. They have 20,000 customers, right? They have over 100,000 users. A lot of them are kind of your typical viral kind of single users, but then there was these massive enterprises that were saying, hey, here's what we need to standardize this across our entire business. And so that was kind of what I would say near adjacent, kind of clear voice of the customer driven approach. That was something, hey, we have a 80% probability of success if we can develop this functionality. I would put that in, pretty high in the priority, and because we know from a probability perspective, high success rate. On the other extreme was things like ecosystems, right? Where the business is pretty well, has pretty good market share in certain ecosystems. And then there is this potential for a bet, right? Which I call truly where maybe the probability of success is, 20 to 30%, but if it hits, it's going to hit big, right? And so what we try to do is have a mix of high probability of success, decent impact, and then always have a couple of what I would say are kind of really interesting options that, low probability of success, but if they hit, they really hit. And I found in business, like you want to have kind of a mix of both. And so it's kind of a almost a barbell approach, I would say, in terms of identifying prioritizing initiatives around that. The core things that are always going to be consistent, helping build out management teams, right? Because a lot of these businesses, again, they haven't kind of fully, they typically don't have full complement of leadership, systems, processes, and then the offshore arm. Those are kind of consistent, right? Because we know every single time that kind of adds a lot of value. And then whether it's around initiatives around product, around go to market, or partnerships, M&A, that is more tailored to the specific opportunity.
How much of this work that you just described are you doing pre-buying
Yeah.
the company while you're vetting the founder versus post?
Um, Typically, in almost every case, we will have run through with the founder kind of our pulleys and gears framework. It's not going to be necessarily finalized, right? But we want to be able to get to like 60 to 70% of the way there because alignment is really important, right? Because the last thing you want to do is, hey, we kind of shook hands, and then the day after, the investor is going in this direction and the founder wants to go in that direction. So to me, that's a critical step, is getting alignment on the vision, alignment on the strategy, and it's a collaborative exercise, right? Such that, because that is what, LPs don't realize this, but that's what really shrinks what's called the J curve, right? Post close is because a lot of people, this again is a consequence of a lot of these action processes where it's just figuring, you close and then you start figuring this stuff out, which is just, takes time and it could cause friction. So I would say that aspect, obviously we do our diligence in advance too, but to me, the milestone, if you will, is that piece.
In working with these founders, are you incentivizing them, given you're coming in at an earlier stage in a lot of cases, are you incentivizing the founders to stay and build the business with you, or are you hoping that they transition out and bringing in a professional CEO?
No, 100%. Look, we'll take the founder's guidance on this in terms of, I would say, operational involvement, but we like people, again, goes back to values that just care deeply. You can care deeply as a board member, right? You can care deeply as a CEO, even a CPO or CTO, right? But it's just more about those values. I would say over time, from an incentive perspective, what I will tell founders is any kind of transaction with us, um, founders will, from an purely economic incentive perspective, will make way more on the second turn, right, than they have at the date of the transaction. And so there's, I certainly believe, right, I eat my own cooking, right, and I'm a big personal investor in every platform I do. Is just that the next outcome, given kind of what we've talked about in terms of the resources that we put to bear, the strategic alignment, is just a much bigger outcome than the initial one.
Yeah, and also the founder is such a critical piece of the secret sauce in a lot of ways. They have this founder market fit. They understand customers in a very deep way. So especially as you're trying to go through some of those strategic things that you mentioned in the pulleys and gears, like they have unique insight that losing that institutional memory kind of makes everything significantly harder.
100%. And this goes back to why it's so interesting to get that thinking and alignment on paper in advance, right? Because that then allows you to go is like, hey, there's the imprimatur there's the stamp of approval of the founder on this, right? So you can then go to the rest of the team and say, hey, this was a joint exercise. This is not just, coming out of thin air. And so that's the other value of getting to that alignment.
Right, right. That's awesome. Okay, and just I think that's a good place to end the episode. But if founders are listening, Omair, and want to learn more about Gearbox and what you're up to, how can they get in touch?
Yeah, the best path would be first, I would say, again, go look at our values, right, on our website. That's www.gearboxcap.com. Or they can reach me on LinkedIn or email me as necessary. But we're open for business. I'm fortunate that since launch in September 22, we've made two great platform investments. We've deployed over 100 million capital, and we're looking for the next one. So, and even if it's just advice, right? Even if you're not interested in sale, like happy to talk.
That's awesome. Yeah, and I appreciate you coming on and just sharing the story and just this different approach. I think founders especially are often looking for partners that want to get deeply involved with their business and understand what the vision of what they're trying to build. So I think it's great that you're building Gearbox, and a lot of founders will likely resonate with that. So appreciate you coming on and sharing all the details around it.
Awesome, man. Thank you so much for having me. This was fun. I love talking about this. So thank you for entertaining
Thanks,
my
Omair.
diatribes.
Yeah, anytime. Thanks, Omair.
Thanks.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So